Oracle just beat Wall Street on every single metric: revenue, earnings, cloud growth, and the stock crashed 12% anyway. Let that sink in. Record profits, record cloud revenue, record backlog, and investors ran for the exits. This is one of the most important warning signals in the entire AI investment landscape right now, and almost no one is explaining what it actually means. Welcome back to AI Assets, the channel where we break down the biggest and most important stories in AI and tech investing every single day. Today, we are going deep on Oracle, ticker ORCL. Because what happened on June 10th and 11th is not just a story about one company having a bad week. It is a story about the fundamental tension at the heart of every major AI infrastructure bet, and it has implications for Nvidia, Microsoft, Amazon, Google, and every other company spending tens of billions of dollars to win the AI race. Let us start with the numbers, because they are genuinely extraordinary in both directions. Oracle reported fiscal Q4 2026 results that beat expectations across the board. Total quarterly revenue came in at $19.2 billion, up 21% year over year, beating estimates. Cloud infrastructure revenue, Oracle's fastest-growing segment, surged 93% to $5.8 billion. Adjusted earnings per share hit $2.03, beating the consensus forecast of $1.96. And the backlog, the future contracted revenue that tells you how much business is already locked in, hit a jaw-dropping $638 billion. That is a 363% increase year over year. 363%. In 1 year, Oracle has nearly double the contracted AI revenue pipeline of any other company on Earth outside of the hyperscalers. By every traditional metric, this was a blowout quarter. The stock should have surged. Instead, it crashed 12%. Here is why. And this is where the story gets uncomfortable. To build the infrastructure to service all that contracted demand, Oracle is spending at a scale that is breaking its own balance sheet. Capital expenditures skyrocketed 162% in fiscal 2026 to $55.7 billion. Free cash flow for the full year came in at negative $23.7 billion. Not marginally negative, negative $23.7 billion. And it is not slowing down. Oracle announced that in fiscal 2027, net capital expenditures will reach approximately $70 billion. To finance that, the company plans to raise $40 billion in new debt and equity, on top of the $43 billion in debt and $5 billion in equity it already raised during fiscal 2026. Let that total sink in. Oracle has raised or plans to raise approximately $88 billion in new capital in just 2 fiscal years to build data centers fast enough to keep up with AI demand. Investors looked at that number and asked one question: what if the demand does not materialize fast enough to service that debt? And right now, the market does not have a confident answer. Now let us talk about what this means for investors. Because the Oracle story is not just about Oracle. The first and most direct impact is on the entire AI infrastructure sector. Oracle's sell-off sent a ripple through every company that is betting big on AI data center buildout. CoreWeave, which went public earlier this year with a business model almost identical to Oracle's cloud infrastructure play, fell in sympathy. So did other data center and cloud names. The message the market is sending is this: it is no longer enough to show demand. You have to show a credible path to converting that demand into free cash flow without destroying your balance sheet in the process. That is a new and much higher bar. And a lot of AI infrastructure companies are not meeting it yet. The second sector to watch is AI chip suppliers. Oracle is one of Nvidia's largest customers. If Oracle's debt load forces it to slow down hardware procurement in future quarters, that is a direct revenue risk for Nvidia and the entire chip supply chain. Not an immediate cliff. Oracle's backlog commitments lock in purchases for years, but a signal worth monitoring carefully. The third and perhaps most important implication is for the AI IPO pipeline. Anthropic and OpenAI are both heading toward public markets with valuations that assume essentially unlimited demand for frontier AI compute. Oracle, which has the largest AI backlog of any non-hyperscaler, just showed that even unlimited demand can destroy shareholder value if the capital required to service it is not carefully managed. That is a narrative that institutional investors will carry into every AI IPO roadshow for the next 12 months. Here is what the market is missing, and this is the angle that will define the next phase of AI investing. Everyone is focused on the debt load. That is the obvious concern. But the smarter question is this: what does Oracle's $638 billion backlog actually tell us about the structure of AI demand? Oracle's remaining performance obligations include $75 billion in prepayments from customers who either paid in advance for GPU capacity or supplied their own chips directly to Oracle. $75 billion in prepaid GPU contracts. Think about what that means. The largest AI buyers in the world, OpenAI, Meta, government agencies, enterprise giants, are so desperate for guaranteed compute capacity that they are paying Oracle billions of dollars upfront, years in advance, just to lock in access. That is not a sign of a bubble. That is a sign of structural scarcity. The demand for AI compute is so intense and so certain that buyers are willing to prepay massive sums just to get in the queue. The investment implication is profound. The companies that own or control the physical infrastructure, the land, the power contracts, the cooling systems, the fiber connections, are now in a position of genuine pricing power. The picks and shovels of the AI gold rush are not just the chips anymore. They are the real estate, the energy contracts, and the cooling technology that makes it all run. That means companies like Vertiv, which makes cooling systems for data centers, Eaton Corporation, which handles power management, and the major data center REITs, are sitting on an asset base that just became significantly more valuable, even as Oracle itself gets punished for the cost of building on top of it. So what happens next? Here are the specific catalysts and dates to track. The first is Oracle's share offering timeline. The company announced a $20 billion at-market equity issuance. When that hits the market, expected in the coming weeks, there will be additional selling pressure on ORCL shares. That could create a better entry point for long-term investors who believe in the AI infrastructure thesis but want a lower cost basis. The second is the Morgan Stanley AI debt report. Morgan Stanley recently projected that global debt issuance related to AI will more than double, reaching nearly $570 billion by the end of 2026, with hyperscaler capital expenditures surpassing $1 trillion by 2027. Watch for any updates to that forecast following Oracle's results. If the estimate gets revised higher, it will intensify the market's focus on AI debt sustainability across the entire sector. The third is Microsoft's and Amazon's upcoming earnings. Both companies report in late July. After Oracle's reaction, investors will be laser-focused on the relationship between AI Capex growth and free cash flow for every major cloud operator. If Microsoft or Amazon show signs of similar cash flow pressure alongside their AI buildouts, the sell-off could broaden significantly. If they show disciplined Capex with improving cash conversion, it will provide relief to the sector. Smart positioning right now means two things. First, do not abandon AI infrastructure. The demand is real. The backlog is real. And Oracle's fundamentals are genuinely strong. The market is not saying AI is over. It is saying it needs to see a clearer path to returns. Second, shift attention toward the companies supplying the infrastructure rather than just operating it. Power management, cooling technology, and data center real estate are where the pricing power increasingly sits, with less balance sheet risk than the operators themselves. Oracle just gave the entire market a masterclass in the difference between demand and returns. Record revenue, record backlog, record cloud growth, negative free cash flow, 12% crash. That combination tells you everything you need to know about where AI investing is heading in the second half of 2026. The era of rewarding growth at any cost is over. The era of disciplined capital allocation is beginning. And the investors who understand that transition and position accordingly will have a significant edge. AI Assets is here to make sure you stay ahead of exactly these kinds of shifts. If you are not subscribed yet, do it right now. That is all for today.